C Limited, SE Investment Research, Target Price, Full Valuation Analysis and Monte Carlo Simulation by Value and Momentum Portfolio. Institutional grade research on C Limited with catalysts to watch and actionable insights for investing. For informational purposes only, no investment advice. Full memo is available on Value and Momentum Portfolio Substack. Deep dive summary. C Limited is currently navigating a transition period where management is actively prioritizing long-term market share over near-term cash generation, creating a setup where the underlying business quality is improving but currently undergoing deliberate margin compression. Top-line growth remains robust with revenue accelerating at plus 46.6% year-over-year, but heavy capital consumption from the $8.8 billion C-Money loan book growing at plus 71%, and active Shopee fulfillment reinvestments are pushing the estimated fiscal year 2026 free cash flow to net income ratio down to 0.98 times. The stock trades at an 18 to 23% discount to our consensus intrinsic value and sits at a 14.7 times EV/EBITDA multiple, representing a 35% discount to peers like Mercado Libre, though its 3.7% trailing free cash flow yield currently aligns with the broader market average until the fintech cash drag subsides. C Limited is fairly discounted but not yet a distressed bargain. A prudent approach is to build a position within the $77 to $88 range to secure a 20% margin of safety, making it a viable growth bet for patient investors with a 3 to 5 year time horizon. From the current share price of $87.28, our base case discounted cash flow target of $110 implies a plus 26% upside. Our sum of the parts valuation of $114 implies a plus 30% upside, and our Monte Carlo probability weighted mean of $120 implies a plus 38% upside. The outcome distribution is asymmetric to the upside. The base case offers an expected net return of plus 38% alongside a 62% overall probability of a gain, while the bear case models a minus 29% downside to an absolute valuation floor of $62, creating roughly a 1 to 1.3 risk-to-reward ratio when weighing the bear floor against the base case target. Company overview. C Limited, headquartered in Singapore, is a consumer internet company operating primarily in Southeast Asia, Latin America, and other international markets. The company focuses on three main business segments: e-commerce, digital financial services, and digital entertainment. Its e-commerce platform, Shopee, is the largest in Southeast Asia and Taiwan and has a growing presence in Latin America. Shopee offers a mobile-centric marketplace with integrated payment and logistics services, catering to both buyers and sellers, which includes small and medium businesses as well as large retailers. C-Money, the company's digital financial services arm, provides consumer and SME credit, mobile wallets, payment processing, and insurtech services, primarily in Southeast Asia and Brazil. This segment is known for its consumer credit offerings and integrated mobile wallet services. C's digital entertainment business, Garena, is a global game developer and publisher known for its popular mobile game Free Fire, which has a large active user base and supports esports activities. The company emphasizes technological innovation, community engagement, and market localization to meet the diverse needs of its users across different regions. Product overview. The company operates a digital ecosystem built on three main pillars. Early on, management used the cash generated from their gaming division to fund their e-commerce and financial technology platforms. Today, these three platforms work together closely, giving C an operational edge against regional competitors like TikTok Shop, Lazada, and Grab. First, there is Shopee, their e-commerce segment. It is a mobile-focused marketplace operating primarily across Southeast Asia, Taiwan, and Latin America, with a notable presence in Brazil. Shopee is the company's primary revenue driver. As of Q1 2026, it brought in 72% of total top-line revenue. For consumers, Shopee offers a social shopping experience with integrated live streaming and in-app games, along with competitive pricing and efficient shipping. For merchants, it provides a large customer base, end-to-end logistics, and digital marketing tools. Shopee makes money in a few ways. They charge transaction commissions based on gross merchandise value. They also generate revenue through their in-house logistics network, SPX Express. Additionally, they sell targeted advertising and hold their own inventory for direct sales to consumers. The second pillar is C-Money, their digital financial services division. It originally started as a payment system for Shopee called Shopee Pay. Now it is a broad financial platform offering mobile wallets, digital banking, and credit lines for consumers and small businesses. C-Money targets the large unbanked and underbanked populations in Southeast Asia. It allows shoppers to check out smoothly and gives people access to credit without the strict requirements of traditional banks. The segment earns money through interest on its credit lines, transaction processing fees, and commissions from selling third-party financial products like insurance. The third segment is Garena, their digital entertainment arm. Garena develops and publishes games. Their standout title is a mobile battle royale game called Free Fire. The game is designed specifically to run well on basic smartphones, making it accessible in emerging markets like India, Latin America, and Southeast Asia. The games are free to download. Garena makes its money through microtransactions, selling virtual items and seasonal passes to its active paying users. What sets C Limited apart is how these three divisions interact. Garena brings in a large, young audience. Shopee captures their retail spending. C-Money processes those transactions and provides credit. This internal loop lowers the cost of acquiring new customers and creates a rich set of data. For example, a user buying Free Fire items with C-Money builds a credit history. They can then use that credit to buy items on Shopee. Competitors who only operate in one or two of these areas find this cycle difficult to match. Technology supports each of these areas. Shopee uses artificial intelligence for product recommendations and routes its own deliveries through SPX Express. This logistics network helps balance delivery speed and cost, letting them compete directly with TikTok Shop on shipping times. C-Money uses transaction data from Shopee to score credit risk. This approach is often more accurate than traditional credit bureaus, allowing them to expand their loan book while managing risk. Standalone financial apps like Grab lack this volume of e-commerce data. Finally, Garena relies on technical compression. They fit high-quality games into small file sizes, allowing their titles to run smoothly on budget hardware. This specific technical focus acts as a barrier to entry for Western developers targeting the same emerging markets. Moat analysis, SE moat, rests on three main pillars. First, there are network effects. Early in 2026, Shopee held about 52% of the Southeast Asian e-commerce market, representing roughly $66.8 billion in gross merchandise value. Buyers attract merchants, which increases product variety and lowers prices, bringing in even more buyers. Second, C has a structural cost advantage through its logistics arm, SPX Express. This network now handles over 50% of Shopee's orders. By leasing warehouse space and optimizing delivery routes, they lowered their cost per order by about 20% year over year in rural areas. They also offer 2-hour delivery in certain urban markets. Third, C-Money leverages valuable data. By analyzing transaction histories from Shopee, C-Money can underwrite loans efficiently. They manage to keep their non-performing loan ratio stable at 1.1%, even as their loan book expanded to $9.9 billion in the first quarter of 2026. Looking at the company's financial health, C has shifted focus from rapid expansion to sustained profitability. For the first quarter of 2026, they reported $7.1 billion in revenue, up 46.6% year over year. Adjusted EBITDA surpassed $1 billion. All three of their main segments are now profitable. The business model is also scalable. Expanding into new markets like Brazil requires localized marketing and logistics rather than building new software. They are also adapting to new trends. To compete with video-based shopping, Shopee invested in live streaming and AI content tools. This effort improved purchase conversion rates by 14% in early 2026. Despite these strengths, the company's barriers to entry are permeable. They face real disruption risks, particularly from TikTok Shop. TikTok Shop currently holds about 18% of the market, with an estimated $22.6 billion in gross merchandise value. It is growing fast, expanding at a rate of 40% to 55%, compared to Shopee's 25% to 30%. TikTok Shop relies on impulse buying from younger consumers. Their average order value sits between $4.50 and $6. Shopee captures broader demographics with higher intent to buy, driving an average order value of $13 to $15. Still, TikTok's social model is actively capping Shopee's market dominance, particularly in places like Vietnam and Thailand. There are also risks in their financial and gaming segments. C-Money recently saw its loan book in Brazil cross $1 billion. If emerging market economies slow down or inflation outpaces wages, non-performing loans could rise. This would require credit loss provisions, which would cut into profitability. Meanwhile, their gaming division, Garena, remains dependent on one title, Free Fire. The game generated $931.4 million in bookings during the first quarter of 2026. Consumer tastes change often, and if Free Fire loses popularity without a strong replacement, C could lose the profit margins that support its other businesses. Competitors are actively taking market share. TikTok Shop is capturing a notable portion of new e-commerce growth in the region. Shopee remains the market leader due to its scale, logistics network, and integrated financial tools. Yet TikTok Shop is now firmly established as the second largest player. To defend its position, C continues to subsidize shipping and invest in technology, which puts pressure on their profit margins as they protect their territory. Pricing power. Over the past 2 years, C shifted its strategy from aggressive growth to sustainable economics. The numbers show they can raise prices on their platform without losing their merchant base. By 2026, Shopee's effective take rate on sellers in key markets like Singapore reached the 10 to 20% range. This includes base commissions of 2 to 6%, transaction fees of 2.18%, and optional service fees for things like free shipping programs. We also see this in their advertising revenue. In the first quarter of 2026, Shopee's ad revenue grew by 80% year over year. The ad take rate increased by over 90 basis points. Sellers are paying more just to stay visible. Importantly, the company preserved its return on invested capital even with these higher prices. 3 years ago, this metric was deeply negative. Heading into 2026, it sits at approximately 9%. At the same time, total adjusted EBITDA surpassed the $1 billion mark for the first time in the first quarter of 2026. Next, we need to consider if C can maintain its revenue and protect margins during economic cycles. E-commerce is sensitive to economic swings, yet Shopee operates with a relatively low average order value, which provides a buffer against downturns. When the economy slows, shoppers often trade down from expensive retailers to discount marketplaces like Shopee. This keeps gross merchandise value relatively stable, even if sales in discretionary categories like electronics drop off. Margin protection, however, is a clear vulnerability for the company. C cannot easily protect its margins through economic cycles because competitive pressure dictates those margins rather than just consumer demand. We saw this when TikTok Shop entered the market. Shopee had to spend heavily on shipping subsidies and marketing to defend its market share. This compressed their margins. Their first quarter 2026 Shopee EBITDA of $223.1 million shows they can generate profits, but they have to constantly adjust their subsidies to compete. When we break down where this pricing power comes from, we see it leans heavily towards sellers rather than buyers. The primary source of their leverage is their market structure and network effects. Shopee holds roughly 52% of the Southeast Asian market share. That accounted for $37.3 billion in gross merchandise value in the first quarter of 2026 alone. Because of this scale, sellers simply need to be on Shopee to reach customers. The cost of switching platforms also highlights this dynamic. For buyers, switching costs are basically zero. A shopper can compare a price on Lazada or TikTok Shop in a matter of seconds. For sellers, switching costs are high. Sellers integrate deeply into Shopee's backend systems. Using Shopee's proprietary logistics network and relying on C-Money's merchant credit creates operational lock-in. Meanwhile, product differentiation is low. E-commerce platforms are largely similar, and Shopee sells the same third-party items as its competitors. Brand loyalty is also moderate at best. Shopee is well known, but consumer loyalty in these emerging markets is driven almost entirely by finding the lowest final price, including shipping. In summary, Sea Limited's pricing power acts like a one-way valve. They hold strong pricing leverage over their merchants, but very little over their consumers. The company uses its market dominance to extract higher commissions and ad spending from sellers. They track this by calculating their effective take rate, which is just their marketplace revenue divided by their gross merchandise value. However, they must turn around and reinvest a large portion of those extracted fees right back into consumer shipping subsidies. If they do not, buyers will simply move to competitors like TikTok Shop. Price action and technical analysis. Let us break down the recent price action for Sea Limited. Back in August 2024, the stock hit a two-year low of $55.28. From there, it climbed to reach a peak of $199.30 in September 2025. Since then, the momentum has completely reversed. The stock is trading right now at $87.28. That is a minus 56% drop from the September 2025 high, marking a clear structural breakdown in the chart. The critical turning point occurred recently during the March 2026 earnings report. The stock took a sharp hit that week, falling from $115 down to $78. That single move triggered a minus 30% loss and served as the key structural break for the underlying trend. When we measure this performance against the broader consumer discretionary sector, Sea Limited is struggling. It currently ranks at the approximately 18th percentile among its peers. This means that approximately 82% of similar companies in the sector are outperforming the stock on a yearly basis. The data shows the company is clearly lagging behind the rest of the market. Financial performance. When we look at the latest numbers for Sea Limited, we see a company that is successfully driving revenue through Shopee and Garena. But that top-line growth is coming at a very high cost. There is a real tension right now between their expansion and their bottom line because management is aggressively pouring money back into the business. Even though revenue is up by 30%, the earnings per share have stayed almost flat because these reinvestments are eating up nearly all the new profit. One of the biggest things to watch is the massive gap between the $4.2 billion they report in EBITDA and their actual free cash flow, which sits much lower between $1.5 billion and $2 billion. This happens largely because their Sea Money loan book has reached $8.8 billion and continues to swallow up available cash as it grows. It is also worth noting that Sea remains an unrated issuer, which is quite unusual for a company of this size. With their fintech arm growing at 71%, not having a formal credit rating could make it harder or more expensive for them to refinance their debt if the market shifts or if credit losses start to climb. Investors have also dealt with some consistency issues, as the company has missed earnings estimates in 9 of the last 10 quarters. This suggests that either the market is too optimistic or management is spending much more than they initially signal. On the positive side, Garena continues to act as a high-margin cash cow that provides the capital needed to fund everything else. They are also seeing real progress with Shopee in Brazil and are using AI tools to bring down their customer service costs. Ultimately, the growth is definitely there, but the path to sustainable, high-quality cash flow remains a bit complicated. Forecasted performance. Our financial model for Sea Limited leans on a conservative base case where we expect Shopee to hit the management target of 25% growth in 2026 before slowing toward 12% by 2030. We have to remember that revenue growth nearly flatlined at 4% back in 2023, so we are projecting that Garena will likely stay flat or even dip after a strong 2026. This cautious outlook extends to margins as we expect to drop to 13% this year because the company is prioritizing heavy reinvestment. We already saw this in the first quarter of 2026 when Shopee EBITDA fell to $223 million from $264 million despite a 44% jump in revenue. Because management is funneling so much cash into fulfillment and user acquisition, we are keeping the Shopee EBITDA margin capped at their 2 to 3% guidance. This spending cycle also means we expect free cash flow to slip to $1.7 billion in 2026 from $2.0 billion the year before. The main culprit here is the C-Money loan book, which currently holds $8.8 billion on the balance sheet and continues to absorb liquidity. While we think loan growth will cool down to about 25% eventually, the capital needed for new originations creates a persistent gap between reported EBITDA and actual cash in hand. Looking further out, net margins seem stuck between 6 to 8% because a rising tax bill and thin retail margins offset the gains from higher revenue. On a brighter note, we do see gross margins climbing toward 51% as the company shifts to high-margin ad revenue and third-party sales. While the overall profit ceiling remains low for now, these structural improvements in the marketplace and fintech segments are very real. Second, derivative analysis. When we look at the relationship between free cash flow and net income, we see a ratio that is currently trending downward. This metric peaked at 2.27 times back in 2024, but it dropped to 1.29 times in 2025 and will likely hit 0.98 times by 2026. This dip below 1 times happens because the C-Money loan book grew 71% to reach $8.8 billion, which effectively traps cash that would otherwise be distributable. We expect this ratio to recover toward 1.37 times by 2030 as loan growth eventually slows down. But for now, it shows that earnings are not fully converting into cash. The company's return on invested capital tells a similar story of a long-term climb facing a temporary pause. We saw a massive improvement from minus 24% in 2021 to plus 15% in 2025, but estimates suggest a slight dip to 14% for 2026. This is a direct result of management's choice to reinvest in fulfillment centers and user programs rather than a sign of a failing business. Return on equity followed the same path by moving from minus 26% up to plus 14%. Though it faces that same pressure this year. The big question is whether this 2026 slowdown is just a cycle or a permanent ceiling on how much profit each dollar can generate. While revenue is not slowing down, the quality of near-term cash is under pressure, and a projected 57% surge in taxes will make it harder for earnings per share to grow. Even though the ad mix and lending business are improving the underlying revenue quality, these rising costs and tax burdens remain significant hurdles for the immediate future. Valuation summary. To wrap up with the valuation, we have to ask if C Limited is actually cheap compared to its peers. If you look at Mercado Libre, C trades at a 35% discount on an enterprise value to EBITDA basis, but it looks a bit more expensive than players like Pinduoduo when you focus strictly on free cash flow. Right now, the trailing free cash flow yield is about 3.7%, which is roughly in line with the broader market. That valuation only gets really attractive if the C-Money loan growth slows down enough to push that yield up toward the 7% to 9% range. The business quality is definitely better than it used to be, especially with return on invested capital jumping 39 points over 4 years and gross margins up by 20 points. However, we are seeing a bit of a stall in earnings quality because earnings per share only grew 11% even though revenue surged by 30%. This gap between top-line growth and bottom-line profit means we are only seeing a partial inflection point right now. Our different models put the fair value between $99 and $114, and with the stock trading at $87.28, that represents a discount of about 12% to 31%. For the stock to really take off, we need to see Shopee margins stay above 2% while loan growth cools down to under 30%. On the other hand, the real risk would be a perfect storm where loan defaults rise just as competition heats up in Brazil and Garena starts to fade. When we weigh everything together, our consolidated target comes out to about $107 per share. At the current price of $87.28, the stock is sitting right at the edge of being undervalued. It is not exactly a deep value play, but it is trading at a meaningful discount to its core fundamentals. What price would make the company undervalued? We have to ask if C Limited is actually undervalued at the current $87 price. The short answer is yes, but only marginally. Our models show a discount of about 18% to 23%. But the stock is currently sitting at the very top of what we consider the undervalued zone. For this to become a truly obvious buy with a strong margin of safety, the price would likely need to drop into the $66 to $70 range. If you are looking at what kind of growth is already priced in, the bar is actually quite low. To simply break even on an investment at $87, the company only needs to grow its free cash flow by 10% annually over the next 5 years. That would bring their cash flow to about $3.5 billion by 2031, which is a very achievable target even in a mediocre scenario. However, if you are aiming for a 15% annual return, the company needs to hit a much higher growth rate of about 23%, reaching $7 billion in free cash flow. That requires near-perfect execution and leaves very little room for error. There is a real bear case to consider where the stock could fall about 29% to around $62. This would happen if free cash flow growth drops below 8%, likely caused by a spike in loan defaults at C-Money happening at the same time Shopee margins stall out. We expect this uncertainty to clear up by the 2027 fiscal report. If free cash flow recovers to $2.4 billion or more, the stock likely heads toward $110. But if it stays under $2.0 billion, that $62 target becomes much more likely. Right now, our Monte Carlo simulations suggest there is a 62% chance of a gain versus a 38% chance of a loss at this price point. It is not a guaranteed win, but the odds do lean in favor of the investor. Ultimately, C Limited looks like a fair bet for someone with a 3 to 5 year horizon. It is not a distressed bargain, but it is not expensive either. At $87, you are essentially betting that management can execute on their growth plan while keeping their fintech risks under control. Insider activity. Let us shift to a highly notable data point regarding internal confidence. From mid-March through mid-May 2026, virtually every executive in the C-suite sold shares on a near-daily schedule. We can break down the estimated totals. Director David Y. Ma led this activity by selling approximately $112 million plus in stock. CEO Xiaodong Li executed approximately $22 million in sales tied to stock conversions. Chief Operating Officer Gang Ye sold approximately $20 million plus, which breaks down to daily trades of approximately $850,000. Additionally, Chief Product Officer Jing Ye Chen and Chief Corporate Officer Yanjun Wang both show ongoing selling activity. It is highly likely these transactions fall under pre-planned 10b5-1 schedules. Even so, the sheer volume and persistence of this selling remains hard to ignore. This stands out particularly for Director Ma, who sold aggressively throughout April while the stock sat in the $80 to $90 range. What would kill the thesis/base case? To understand what might derail our investment thesis for C Limited, we have to look at the specific risks that could hit their free cash flow. The most severe threats are tied to the C-Money segment, where a spike in non-performing loans above 3.5% could wipe out $300 million to $600 million in cash every year. While we only see a 15% probability of that happening, a full-blown crisis with defaults over 5% would be even more catastrophic, potentially draining up to $1 billion annually. Right now, the market hasn't priced in that level of loss, though it is encouraging to see that the current default rate is holding steady at 1.1%. We also have to keep an eye on a 57% year-over-year jump in taxes, which cost the company $214 million in just the first quarter of 2026. If the tax rate stays above 37%, it could become a permanent drag on their cash flow. Shopee also faces some high-severity risks, particularly if its EBITDA margin stays stuck below 1% for the next few years. We already saw some of this pressure when Shopee's EBITDA dropped 16% to $223 million in the first quarter of 2026. This margin compression is closely linked to competition, as there is a real chance that Mercado Libre gains ground in Brazil or TikTok Shop takes market share across Southeast Asia. A significant loss to TikTok could reduce gross merchandise value by as much as $2 billion. And while management is being cautious in their guidance, the market has only partially factored in these competitive threats. Finally, we have to monitor some medium-severity risks, like a potential decline in Garena as its core games age. There was a 25% chance of this happening, But the latest data was actually quite positive, with gaming bookings jumping 20% in the most recent quarter. We also look at the 15% probability of a currency shock in emerging markets, which could erase up to 20% of reported revenue. While the company is managing through these challenges for now, the real danger to our base case would be if several of these risks, like rising loan defaults and stalling Shopee margins, happen at the exact same time. Key takeaway. The bottom line is that C Limited is prioritizing long-term market share over immediate cash. While revenue is growing rapidly, earnings per share only moved up 11% because management is intentionally narrowing Shopee's margins to reinvest. This shift caused a year-over-year drop in EBITDA for the first quarter of 2026. At the same time, the $8.8 billion C-Money loan book is absorbing so much liquidity that the cash conversion ratio has fallen below 1. Technically, the stock is sitting at $87.28, which is right near a support level between $82 and $86. It has been a rough stretch, with shares down 56% from their peak. We see the stock as marginally undervalued right now, but it doesn't offer a massive margin of safety yet. A sensible approach would be building a position in the $77 to $88 range, which provides a 20% cushion against our $110 base case target. If the business hits our sum of the parts valuation of $114, you are looking at an upside of 26% to 30%. However, if fundamentals break down, the price could drop to our bear case floor of $62. Several catalysts will decide where the stock goes next. To move higher, the market needs to see C-Money loan growth slow to under 30% and Shopee margins return to that 2% to 3% target. The real test will be the 2027 free cash flow report. Hitting $2.4 billion would be a major win. On the flip side, any spike in loan defaults above the current 1.1% rate or a margin stall below 1% would trigger heavy selling. It is a bit of a conflicting story. Revenue growth is accelerating at 46.6%, yet the stock remains in the bottom quintile for its sector because of consistent earnings misses. Interestingly, while analysts have price targets ranging from $108 all the way to $163, insiders have been selling shares systematically for months. This suggests that while the growth story is real, the market is demanding proof of better margins before it fully commits. For now, the stock is trading below every analyst target, which means it is either a great bargain or those targets haven't yet accounted for the current margin pressure. Disclaimer, this report is provided strictly for informational purposes and does not constitute financial advice, an offer to sell, or a solicitation to purchase any securities. All information is sourced from public filings and is considered current only as of May 20th, 2026.